Domino's is down over 15% today on its earnings day. The stock is back to its 52-week low, and the last time it traded at those levels was around, February or March of 2020. So in this video, I'm going to do a quick overview over, my valuation model on the stock. We're going to talk around earnings a little bit, talk about, everything, and try to determine a good buying opportunity and a good fair value for us to buy Domino's Pizza at. So again, I hope you enjoy this video. Now, taking a quick look at earnings, again, I have to be honest, it's not the best earnings ever, even with their promotional discounts, such as a 50% discount on some pizzas. For limited time, the US same-store sales climbed just 0.9%, missing expectations for a 3.69% rise in the revenue estimate. So again, this is a big miss on Domino's. And they also missed on revenue, but they did beat on adjusted, earnings per share of $3.97 versus $3.94 as expected. And the same store sales on a fiscal year was actually declining 0.8% for 2022. But to be fair, we can't really compare much to what we had in 2021, where we still had some type of cities that were, some type of a lockdown. We had, a lot of things around the stimulus checks. People had much more money. They had much lower debts than we have right now. And now the situation is very, very different from what it was in 2021. And this is what I try to cover in my macro type of videos about the savings rate being lower than it was in the 2008 financial crisis, and people just cannot afford the things that they used to be able to afford just, a couple of months ago or even a year ago. And it's only going to get worse from here, and the company cut its 2 to 3 year sales outlook in the range of 4 to 8% type of growth from 6 to 10% growth, citing what? Macroeconomic headwinds weighting down on its domestic delivery business, which again, they were suffering from. And this was a big tailwind for the company in their growth in 2021 and even in early, 2022. Now, taking a look at where Domino's is actually trading, it's now trading actually at 22 times earnings. And I calculated this myself using their $500 million net income and then taking, the share price and then timing it by the shares outstanding to get the market cap. So the market cap right now is around 11 billion, therefore it's trading around 22 times earnings. And looking at the history of the company, it traded at a mean of 23 times earnings. So now we are below the mean. But in 2012 to 2013, it traded 18 to 15 times earnings. And even in 2011, it traded at 10 to 11 times earnings. But looking at what we had pretty much over the past 10 years, if you bought Domino's, around 22 to 23 times earnings, like what we have right now, you actually got a very good deal and a very good buying opportunity at such level. But again, Domino's now has much slower growth and much more headwinds than it had before. So this is why we're going to take a look to try to find some type of a justifiable multiple for us to buy, Domino's at. And many of you would look at, Domino's and think, yeah, 22 times earnings or even 25 times earnings is very, very expensive for such company. And I do agree, but we have to keep in mind that Domino's is a higher quality type of business and it has high return on capital, which does justify some type of a premium for the, company. They also have pretty good management. They have been buying back their shares aggressively. They bought up pretty close to about 40-45% of their shares over the previous 10 years, which is again pretty, amazing from the company. So this is why I believe it deserves some type of a premium. Many people, for example, they look at the difference between AutoZone and Advanced Auto Parts, and they say, why would you buy AutoZone if Advanced Auto Parts is trading at 10 PE and AutoZone is trading at 20 PE? Yes, but AutoZone has around 40% return on invested capital, and Advanced Auto Parts barely has 8 to 10%. So this is one of the reasons why sometimes you have a higher quality business, you have to put up some type of a premium valuation on such thing because it's more of a quality than actually some type of a cigar butt. But many people can't really tell the difference between the two. Now, I believe most of you are actually familiar with the business model and how Domino's Pizza make money. They make money selling pizzas, but they also have, their own company operated stores. They have franchisee stores, which is a pretty profitable business where they collect royalties from the people that own those and operate those type of franchises. And they also have their own supply chain, which is tomato sauce and other type of things that they actually sell to those type of locations. So this is how Domino's makes money. But looking at their balance sheets, they have around 250 million of combined cash and cash equivalent of long-term debt. They have pretty close to 4.9 billion, pretty close to $5 billion of long-term debt. And again, this might be concerning to many, but Domino's has pretty stable net income of around $500 million a year. They can pay back their entire debt 10 years from now if they really wanted to. And their business is actually pretty stable. Yes, they suffered some type of revenue, but it's still growing and it's pretty stable. So again, whenever I have a business model that's actually sustainable and something that people really need and not just really want, I don't normally worry about the debt too much as other people actually believe, as long as the business model is stable for them to be able to pay it back. But I would like to see Domino's pay them back. They were buying shares at the peak, which again, something I don't like. I like business models that buy back their own shares whenever it's slow, not whenever it's trading at historical highs. And this is a big mistake from the management. But again, everything we talked about doesn't really matter. What matters is the valuation model for us to determine if Domino's Pizza is a buy or not. Now, looking at my valuation model, I have pretty close to $4.5 billion of revenue for 2022 for the fiscal year. 2023, I have 4% revenue growth because I believe this year will be some type of a recessionary year where they're not going to be able to grow 8 to 10% like they normally do. So I put in only 4% revenue growth, which I believe is fair. And as you can recall, the company called for 4 to 6% revenue growth for the next 2 to 3 years. So I put in 6%, pretty stable from 2024 to 2027. I used the same net income margin of 10.5%, 10.5%. I used the same PE ratio. I did not put Domino's trading at 25 times earnings. I think 22 times earnings even on the higher side. I would personally not be willing to pay more than 20 times earnings, no matter how good the business model of Domino's actually is. But just to illustrate an example in this video, and just to use the 22 PE ratio, we get a market cap of pretty close to 14 billion. Now, the current market cap is pretty close to 11 billion, and which is only a 51% on the upside over the next 5 years, or 10% compounded every single year. And this does include a dividend and the buyback. I put them together, meaning if they buy back 3.5% of their market cap every single year, and they keep issuing their 1.5% dividend, I put in 5% for a shareholder's yield. And all in total, it's only a 10% return, and this is even pushing it, from Domino's at such prices. Now, for me to actually double my money on Domino's over the next, 3 to 5 years, I would have to buy Domino's around $200 per share, which again, to many of you, it may seem that it's impossible and it will actually never happen, because that would be, around their August 2019, type of low, even would be, lower than that. But again, I'm looking at all the metrics and I don't believe I'm making a mistake. And it still does look to me that, Domino's Pizza is pretty overvalued at such levels. Even though if I use a, 25 times earnings, it's only 68% on the upside. It's not a double, for me to buy Domino's at such prices. But if I had to buy Domino's, I would buy it somewhere close to the $222 per share. Somewhere close to 220, 230, some type of level. At least that would give me some type of a margin of safety if I'm making a mistake with the valuation. And that would, give me somewhere pretty close to a double on, Domino's. But I'm not a buyer of Domino's at such prices. I rather put a price alert on it and get notified if Domino's at least goes below $250 per share, then I can monitor it more and determine a good entry position. But again, taking a look at my valuation model, I don't believe Domino's is a buy. Now, that doesn't mean that Domino's stock can't go up from here because it's oversold or whatever. But again, look looking just at the pure valuation model, not at where the stock is going. I don't know where it's going, but as a valuation model, Domino's is not a buy at such prices. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.